I truly believe that this is the most overlooked and powerful tax strategy available to high-income families and earners, and all it is one box you need to check on your tax return. The tax strategy that I'm referring to is real estate professional designation. Now, before I go into too much depth, what I want to do is paint a very simple example of what real estate professional is, and then I'll go into some of the misconceptions behind how you can qualify and if you are someone that this tax strategy is available to, and if it makes sense pursuing. Let's take a very simple example. When you look at investing in real estate generates what's called depreciation. These are paper losses. This is the building over time depreciating, which the IRS and the government give you a tax deduction on that depreciating asset. There's two main buckets of income. When you invest in a real estate investment, it's generally called a passive investment that generates passive income as well as passive losses. That's the depreciation. That's the bucket over here. The other bucket is what's called or referred to as active income. Active income sits over here. Active income is going to be, let's just say, W-2 income. If you're a business owner, this is all the ordinary income that business produces. This could be anything as it relates to capital gains. This is if you invest in stocks and they sell, that generates an active gain on your balance sheet. So when you are a real estate professional, what happens is that both of these get merged into one. Your passive losses are no longer treated or looked at as passive. They're looked at as active, meaning you can use all the losses, the depreciation that are generated on this side to offset any gain on your active side. This includes W-2 income. Now, let me just give you a very simple example of how this works in practice. If you are a high net worth business owner and you own a business, and let's just say your spouse does not work. She might be involved in the business in some capacity, but let's just say she's a stay-at-home mom. Or in this case, if it's the high net worth woman that's the spouse, maybe the dad stays at home. Now, let's just say that business owner owns a couple of rental properties. They might own the physical structure, the physical real estate that business operates out of, or they might own one or a handful of investment properties. These can be even long-term single-family rentals. Now, if that's the case, all that they would need to do is now that we've identified that the spouse doesn't work, we then need to qualify her as what's called a real estate professional. Since you guys file jointly, it allows for that spouse to elect the real estate professional, and the tax return can then benefit from the full gamut of the real estate professional designation. In this example, if the spouse is able to quantify and prove that they spend 750 hours within a calendar year on that rental real estate or any real estate activity. They also do this more than 50% of any other activity, so they don't have a W-2. This is their full-time / part-time job, and they're able to document those hours. At that point in time, they are a real estate professional. Now let's give it a further kind of detail of like why this would be important. Like, why would you want to do this? Now let's just say you had 3 rental properties. Every year they're going to generate some form of depreciation on your tax return. Now, if you're a real estate professional, that depreciation can be used to offset all of the passive income, all the rental income that property is producing. However, it could also be used against any ordinary or W-2 income that the working spouse is generating, saving them on average 30 to 37% depending on their tax bracket. Now, if you wanted to take that a step further, once you classify as a real estate professional, what this does is it opens up a totally new universe available to you to significantly reduce your taxes and start to invest in strong cash flowing real estate investments that produce large upfront depreciation. One example of this would be mobile home parks, where I focus. Mobile home parks are very unique in that it's mostly land improvements, meaning that they produce a large upfront year one loss, paper loss, depreciation on investors' K1s. That has to do with things like cost segregation and bonus depreciation, which we can go into more detail on, but let's just keep this simple example going. Let's say that this business owner is pulling in $500,000 of ordinary income every year. The spouse makes an investment for $100,000 into a highly depreciable real estate investment. Let's just say a mobile home park. They invest in $100,000 that generates $100,000 of year one losses on their K1. Now remember, when I talked about these two different buckets, that loss, that $100,000 loss for that $100,000 investment gets generated on this side. But since now we've already identified that you're a real estate professional, you could use that loss against the $500,000 of active income that the other spouse produced. What happens is that when you do your taxes, your CPA is going to look at that $100,000 of excess loss of depreciation, and they're going to use that loss against the $500,000 of ordinary income that got pushed through on the tax return. What happens in practice is now that CPA says to the IRS, we actually didn't make $500,000 this year. We only made $400,000 this year. If you're taxed at, let's just say 30% for ordinary income on the federal side, you just saved $30,000 in taxes by making an investment for $100,000. Now that $100,000 investment, you hope that you're putting it towards a good investment, right? You don't want to just get a write-off to get a write-off. You want that money to continue to work for you and cash flow for you. So that $100,000 saved you $30,000 in your taxes. Let's just say cash flow is at 5%. So you're going to be making $5,000 per year in cash flow, and it will grow over time, both the cash flow and the appreciation. So you're effectively making investments at a discount. You're saving money on your active income, you're reducing your tax bill, and it's the best way that I see where you could effectively get a 30 to a 37% off discount on investing in real estate. And then the cash flow that gets produced every month or every quarter is very tax efficient as well for the real estate that you invested in. The reason because of that is that the IRS and any state agency, so I live in California, so the California State Franchise Board looks at it as that you put $100,000 in and you haven't received back that $100,000. So the income that you receive every month is tax deferred, meaning you won't have to pay federal or state taxes on that income, depending on how the investment is structured. If it's like us, we structure it as a return of equity. It's not that we're paying you back your $100,000 investment with the distribution. It's that the way that the tax authorities look at it is that you still have $100,000 at risk, and we're not going to tax you on that income until you've recouped at least $100,000 back of your original investment. That's a pretty simple example, right? On a $100,000 investment for someone that's making $500,000 a year. But what this allows for is to start planning ahead. If you're thinking about either selling any sort of other investment properties, or you're thinking about selling a business, or you know that this year or in future years, you're going to have opportunities where you're going to receive a large taxable event. What this does is now you have a avenue to then defer or offset those capital gains. And all you're doing is you're getting rewarded by the tax authorities for keeping your money invested into the economy. The IRS and any state tax authority rewards investors and owners. They punish income earners, wage earners. And so this is a way for you to get rewarded for keeping your money in the economy, stimulating the economy, and then you're benefiting from all the tax benefits from reducing your tax bill and then growing your net worth and then living off the cash flow, the tax efficient cash flow. So it's just one of the many ways that high net worth families are able to reduce their taxes and start to compound and build net worth and passive income without complicating their lives and changing anything that they're doing currently besides making sure that they check one box on their tax return and then document the hours that they are actively involved in their rental real estate. So now that you know a little bit more about real estate professional designation and the power behind it, I want to go through some of the misconceptions that I hear every week from other CPAs or other clients. The first and foremost, I hear this all the time. I would love to be a real estate professional. However, my wife doesn't want to become a real estate agent. This is the biggest misconception. You do not need to be a real estate agent or a broker to qualify for a real estate professional designation. All you need to do is make sure that you own at least one rental investment property. And it can't be a short-term rental. It needs to be a long-term rental. Now, the second misconception that I hear, and it has to do with how many doors or how many investments you need to have. You only need one to qualify. So one rental property to qualify. Many people ask me all the time, they say, well, Ben, we only have one rental. Don't I need to have like 5 or 10 different rentals to qualify? The short answer is no. You just need one. And what is more important than how many doors you have is the hours that you dedicate to the rental real estate investment business, meaning you need to track your hours. A common misconception I get is like, Ben, how could I ever spend 750 hours on one rental property? The answer is that, yeah, it's a bit challenging, right? It's about 12 to 15 hours a week that you would need to dedicate, improve, and document that you participate on that one piece of rental property. However, this is another misconception. You don't need to spend all 750 hours on that one rental. The way that the code is written is that you are involved in the rental real estate business. So then you're able to combine all hours of activity. Now, what are some different activities or different hours that you can start to quantify and document? This could be things like looking at another investment property, talking to brokers or listing agents. This could be looking at design if you're thinking about remodeling this rental property. This could be going to different workshops or educational content, seminars, speaking to other professionals. This could be driving to the property to look at it, to pick up rent. All of those hours qualify. You don't have to just spend the 750 hours just on that rental property. The purpose of this is not to really be doing any sort of like tax fraud or anything like that. What you're saying is that, hey, I'm dedicating my life in at least in a part-time capacity, 750 hours a week, into the rental real estate business. So it's not about how much rental real estate you have. It's the process of essentially getting into that business, right? And it's everything would count towards it. All those hours would count towards it. The way I look at it is not necessarily focusing just on that one rental property. It's a paradigm shift of thinking about, look, my family is in the real estate business. We have kind of dedicated and structured our life from a tax as well as an investment side to focus on real estate. We like real estate. We understand it. We want to invest in it. And so it's not just about having 20 doors that complicate your life. It's about finding avenues that you're really interested in and dedicating a portion of your hours every year professionally on actively being involved in the business. And so that is a huge misconception. And hopefully that is clear for everyone that you don't need to just dedicate the 750 hours on that one property. It's all things that could be related to this business, this family business that you have now started and you're participating in. Other hours can include, even if you're talking to somebody like myself or you're watching this video, you're educating yourself on something that has to do with rental real estate. You watching this video would count towards those hours, right? As long as you document them, you can prove them, and you're not building the hours retroactively. You want to be prepared in the event of an audit to have a Excel sheet, a Google Calendar, some sort of documentation that when you go and deliver that to say the IRS, you say, here, this is what I did last year. Here's what I was doing on this date for these many hours. I watched these videos. I dedicate myself to driving down to the property. I was on Zillow looking at some other investments. I was talking to my tax attorney. I was talking to a real estate broker, anything and everything that has to do with the rental real estate business. So I think it's more about not the what, it's the how. Like, how do I think about documenting these hours? What should I be focusing my time on? And then talking to your CPA and getting a plan in place to then allow yourself the highest probability of success. Because the last thing that anybody wants to do is stress over whether or not I'm in that gray area. The way that you move further from the gray and more to the black is by having the documentation that's setting your eyes that this is going to be a priority for your family and that you guys are going to start investing in the real estate business and dedicating the time and effort that it takes to document the hours. The last and the final misconception is that we have solidified that we are a real estate professional. But your investments are passive investments, right? The clients that invest in these investments They're limited partners. They're not actively involved in the day-to-day management of those investments. So how can they use that depreciation against their active income? Now, this is a common misconception. And one of the most important things is how we structure the investments. The investments are LLCs taxed as partnerships. And while they are, in fact, a passive investment, a passive vehicle for the investors, there's something called the grouping or aggregation strategy that's very important for your CPA to elect and look into. And what that does is essentially takes all your real estate activities and groups them all together. That way, all passive investments, whether you're investing in an investment with us at Comfort Capital or anyone else, those losses get treated no different than the losses that you generate from your actively managed rentals. The most important piece is solidifying real estate professional designation. Once you have that, the rest of the stuff is just kind of nuances of just speaking with your CPA, speaking to me. I can provide you with all of the documentation to run to your CPA that's backed by tax court that literally is the CPA speak, if you will, because I am not a CPA. I don't claim to be one, but I do have the opportunity to work with some of the top CPAs and tax attorneys across the country. And I've seen it from time and time again. And I've never seen pushback after we have provided the correct documentation of how to think about it and using this grouping and aggregation strategy that then allows you to group all activities, whether they're your own rental properties or their passive investments through groups like Comfort Capital, and then be able to utilize the passive losses or all the depreciation that it generates against all active income. So that is another kind of nuance that I hear or misconception that I hear. One of the things that's important also to hammer out is that, say you're a high net worth business owner or earner and your spouse doesn't work, but you do not own any rental properties. Some of the times what I hear is that, hey, well, I invest in 10 or 12 or 30 limited partnerships, LLC structures, passive investments, and my wife manages all those investments. Does that make us a real estate professional? The answer is no. You need to own your own rental property that you actively participate in. That means that it needs to be owned in your trust. It needs to be owned in an LLC that you're the majority owner of. And then if that's the case, then you can qualify for a real estate professional and then utilize all of the depreciation that those other limited partnerships, those passive investments are generating, that depreciation that's generating against active income. So you have to own at least one rental property. Let's just say you are a high net worth business owner and the last thing that you want to do is own another business, right? You don't want to own rental properties. I think this is a lifestyle decision and it's a choice, but some of the things that have been helpful when I've coached and tried to talk to these individuals is that, look, don't overcomplicate your life. Do you own the physical structure that your business operates out of? A lot of times they say, yes, we do, right? And we actually own a couple other industrial assets and they're kind of low maintenance, if you will. If that's the case, what I would do is I'd say, well, you have to manage that real estate, right? You're the business owner. Why don't you have your wife manage that real estate, right? Even if you're the tenant, right? Because you own that piece of real estate and you lease it to yourself. Someone has to own it, right? Has to own it and manage it. Someone has to put together the lease agreements. Someone has to dictate what rents are. And so I try to think more creative on like, how can I make the real estate professional designation make sense for my life, for my family, rather than trying to go out and buy a bunch of rentals that make no sense, that are going to cause you more headache, that are going to cause you more stress in your life just to benefit from the tax benefits. So I think that there's a lot of ways to be creative and not every situation fits every kind of outcome. And it's important for you to kind of sit down with your family. You could talk to folks like myself. You could dive into our investor circles where we have a lot of content with our CPAs. But I think the way to look at it is that there's kind of a roadmap. And what I always say to people is that life is a pick your own adventure book and find ways where this makes sense. If you are very focused on how to reduce taxes, this is by no doubt the most powerful tax strategy available on the planet. And so if that is important to you, then it's important for you to chat with your spouse, look at what you currently own, look at creative ways of how you can own rental real estate, reduce the complexity in your life, Make sure that you're actively managing and documenting the 750 hours proactively, and you are planning ahead and not coming to the end of the year or right before you do your taxes and try to find ways to save money then. The best time is now. The best time is always to start to figure out what would we have to do? Start talking to your CPA, because remember, your CPA just files your taxes. You need to own the tax strategy. And so what I have found is that no CPA out there is going to tell you how to reduce your taxes. And so it's your job to then present the questions to them, press them on how can I be a real estate professional? What would I need to do? What is the correct way to document these hours? How do I make myself bulletproof if we were to go through an audit? That way you could set up your life and reduce tens, if not hundreds, if not millions of dollars in taxes, grow passive cash flow, passive net worth, and be able to have something that you could then hand off to the next generation. So if this is helpful, or if you find this really interesting and you want to learn more, dive into our investor circle. I'm not a CPA, but in the investor circle, you'll hear directly from our CPA talking about all things real estate professional designation. How do you qualify? Who qualifies? How to document your hours? And in fact, while you watch all of those videos and educate yourself, those hours would go towards your 750 hours per year. So it's just a great way for you to just get more educated on real estate taxes, how to take control of your life, how to reduce your taxes, how to grow more passive income, as well as going towards your 750 hours per year that you need to document and quantify your involvement in the rental real estate investment industry.